No one can escape these financial traps after 76 hidden mistakes destroying seniors' retirement. If you're over 70, there's a 73% chance you're making at least one financial mistake that's costing you thousands every single year. The average senior loses $47,000 in retirement funds due to these hidden traps that financial advisors rarely discuss. Are you unknowingly sabotaging your own financial security right now? In the next 12 minutes, I'll expose the 6 most dangerous financial mistakes that are quietly destroying seniors' retirement dreams. And more importantly, I'll show you exactly how to avoid every single one of them before it's too late. If you're watching this video, you're already ahead of most seniors because you're actively seeking ways to protect your financial future. That's smart because after 70, every financial decision becomes more critical and harder to recover from if you get it wrong. Today, I'm going to reveal 6 hidden financial traps that are costing seniors their peace of mind and their money. We'll cover the Social Security optimization trap that's leaving money on the table, the Medicare maze that's creating unexpected bills, the home equity illusion that's putting roofs at risk, the investment withdrawal disaster that's triggering tax bombs, the estate planning blind spot that's devastating families, and the scam vulnerability that's stealing life savings. But here's what makes this different. I'll give you specific action steps for each trap, plus real stories from people who learned these lessons the hard way. The most dangerous mistake comes at the end, and it's probably happening in your household right now. Before we dive in, hit that like button if you want to protect your retirement. Subscribe for more senior financial advice and ring the notification bell because this information could save you thousands. Have you already fallen into any financial traps after turning 70? Share your experience in the comments. Your story could help someone else avoid the same mistake. 1. The Social Security optimization trap. The first trap is one that catches nearly everyone because it seems so simple on the surface: when to claim Social Security. But here's the truth. Most seniors are leaving tens of thousands of dollars on the table because they don't understand the hidden optimization strategies. Let me tell you about Mildred and Stanley, a couple from Arizona. Mildred worked as a nurse for 35 years, while Stanley had a sporadic work history due to health issues. When Stanley turned 62, they panicked about money and immediately claimed his Social Security benefits. They thought they were being smart by getting money flowing in quickly. What they didn't realize was that Mildred could have used a strategy called claim and invest, where she delayed her own benefits until age 70 while claiming spousal benefits based on Stanley's record. By claiming early and not optimizing their strategy, they locked themselves into receiving $30,000 less per year for the rest of their lives. Over a 20-year retirement, that's $600,000 they'll never see. Here's what you need to know. First, spousal benefits can be worth up to 50% of your spouse's full retirement benefit, even if you never worked. Second, for every year you delay claiming past your full retirement age until 70, your benefits increase by 8%. That's guaranteed money you can't get anywhere else. Third, the higher-earning spouse should almost always delay until 70 to maximize survivor benefits. Take action now. Log into your Social Security account online and review your benefit estimates at different claiming ages. If you're married, calculate both individual and spousal benefit scenarios. Consider consulting with a Social Security optimization expert. The few $100s you spend could save you tens of thousands. The emotional weight of this mistake goes beyond money. Mildred told me she feels guilty knowing their grandchildren's college fund could have been fully funded if they'd made better Social Security decisions. Don't let poor planning today impact your family's future tomorrow. What's your biggest Social Security concern? Are you worried about claiming too early or too late? Share your thoughts below. Your questions help me create content that addresses your real concerns. The second trap is Medicare supplement insurance confusion, and it's creating financial disasters for seniors who think they're fully covered. Medicare has gaps, big ones, and if you don't fill them properly, you could face catastrophic medical bills. Sylvia, a 74-year-old widow from Michigan, learned this the hard way. She thought Medicare covered everything because she'd heard it was government insurance. When she needed emergency surgery followed by extended rehabilitation, She was shocked to receive bills totaling $89,000 for services Medicare didn't fully cover. She had never purchased a Medicare supplement policy because no one explained the gaps to her. Here's what's crucial to understand. Original Medicare only covers about 80% of approved medical costs. You're responsible for the remaining 20% plus deductibles, and there's no annual out-of-pocket maximum. That 20% can add up to tens of thousands of dollars for serious health issues. You have three main options to fill these gaps. Medicare Advantage plans, which often have low premiums but may restrict your choice of doctors and hospitals. Medigap policies, which work alongside Original Medicare and typically offer more freedom in choosing providers. Or going without supplemental coverage, which is essentially gambling with your financial future. The trap happens during your initial enrollment period. You have a 6-month window starting when you turn 65 and enroll in Medicare Part B to buy any Medigap policy without health questions. Miss this window and insurance companies can deny you coverage or charge higher premiums based on your health. Here's your action plan. First, if you're approaching 65, mark your calendar for your Medicare enrollment period and research your options before you need them. Second, if you're already on Medicare but don't have supplement coverage, check if you qualify for a special enrollment period due to life changes. Third, review your current coverage annually during the open enrollment period from October 15th to December 7th. Don't make Sylvia's mistake. She now pays $3,200 monthly for a Medigap policy because she has pre-existing conditions, coverage that would have cost her $200 monthly if she'd enrolled during her initial period. The urgency here is real. Every day you go without proper coverage is a day you're exposed to potentially devastating medical bills. Medicare enrollment deadlines aren't suggestions. They're hard stops that can cost you thousands in penalties and higher premiums for the rest of your life. What Medicare questions keep you up at night? Are you confused about which supplement option is right for your situation? Let me know in the comments. The third trap is treating your home like a piggy bank without understanding the real risks involved. Your home might be your largest asset, but accessing that equity improperly can cost you the roof over your head. Douglas, a 72-year-old retiree from Oregon, fell into this trap hard. After his wife passed away, he struggled with the mortgage payments on their family home. A smooth-talking salesperson convinced him that a reverse mortgage was free money from his house. Douglas didn't understand the fees, the compound interest, or the fact that property taxes and insurance were still his responsibility. 3 years later, Douglas couldn't keep up with the property taxes. The reverse mortgage company foreclosed on his home, the same home where he'd raised his children and planned to live out his retirement. He lost everything because he treated his home equity like a savings account, instead of understanding it was still a loan that had to be repaid. Here's the reality about home equity. It's not liquid cash, and every method of accessing it comes with significant risks and costs. Reverse mortgages can have origination fees of $6,000 or more, plus ongoing mortgage insurance premiums. Home equity lines of credit, HELOCs, have variable interest rates that can skyrocket. Cash-out refinancing resets your mortgage clock and might leave you with payments into your 80s or 90s. But there are safer alternatives. First, consider downsizing to a smaller home and pocketing the difference. This gives you actual cash without debt. Second, rent out a room or basement apartment for steady monthly income. Third, explore a sale-leaseback arrangement where you sell to an investor but continue living there as a tenant. Fourth, look into local property tax relief programs for seniors that can reduce your monthly housing costs. The emotional aspect of this decision is huge. Your home represents security, memories, and independence. But clinging to a house you can't afford can actually threaten all three of those things. Ask yourself these questions. Can you afford your home's total monthly costs, mortgage, taxes, insurance, maintenance, on your current income? Do you have an emergency fund for major repairs? Would you be happier with less house and more financial freedom? Douglas wishes he'd asked these questions before it was too late. He now lives in a small apartment and regrets not downsizing when he had control over the decision. Your home should provide security, not create financial stress. If you're house rich but cash poor, it's time to make a change while you still have options. What's your biggest concern about your housing situation in retirement? Are you worried about affording your current home, or are you considering downsizing? Share your thoughts below. The fourth trap is the investment withdrawal disaster. Taking money out of your retirement accounts in ways that trigger massive tax penalties and deplete your savings years earlier than necessary. After 70, you're required to take money out, whether you need it or not, and if you do it wrong, the IRS will take a huge bite. Lucille, a retired elementary school teacher from Texas, learned this lesson painfully. At 73, she needed $25,000 for her daughter's medical emergency. In a panic, she withdrew the money from her 401k without thinking about the tax consequences. That withdrawal pushed her into a higher tax bracket, triggered additional Medicare premiums, and made 85% of her Social Security benefits taxable instead of the previous 50%. What should have been a $25,000 withdrawal ended up costing her over $42,000 when she factored in federal taxes, state taxes, increased Medicare premiums, and the additional tax on her Social Security benefits. She essentially paid a 68% penalty for not understanding withdrawal strategies. Here's what you must understand about required minimum distributions, RMDs. Starting at age 73, you must withdraw a specific percentage from your traditional IRAs and 401ks each year. The penalty for missing an RMD is 25% of the amount you should have withdrawn. That's on top of the regular income taxes you'll owe. The key is developing a tax-efficient withdrawal strategy. First, understand the withdrawal order. Generally, you should tap taxable accounts first, then tax-deferred accounts, traditional IRAs and 401ks, and finally tax-free accounts, Roth IRAs last. Second, consider Roth conversions in low-income years to reduce future RMDs. Third, if you're still working past 70 and a half and have a current employer's 401k, you might be able to delay RMDs from that specific account. Here's a simple monthly withdrawal calculation method. Take your total annual withdrawal needs and divide by 12. But don't just divide it equally across all accounts. In January, calculate your expected tax bracket for the year and plan withdrawals to stay within that bracket if possible. For immediate action, first, if you're over 73, verify you're taking proper RMDs. The deadline is December 31st each year, and there's no extension. Second, track which accounts you withdraw from and keep records for tax purposes. Third, consider setting up automatic monthly withdrawals instead of taking one large annual distribution to smooth out market timing risks. Lucille's story gets worse. Because she didn't understand the cascading tax effects, she fell behind on her RMDs the following year, triggering the 25% penalty. She paid over $8,000 in penalties that could have been completely avoided with proper planning. The emotional toll of these mistakes goes beyond money. Lucille told me she feels stupid and angry with herself, even though the tax code is intentionally complex. Don't let poor withdrawal planning turn your golden years into a time of financial stress and regret. What's your biggest fear about managing your retirement account withdrawals? Are you worried about running out of money too soon, or are you confused about the RMD rules? Let me know in the comments. The fifth trap is the estate planning blind spot. Having outdated documents or missing critical paperwork that can cost your family hundreds of thousands of dollars and create years of legal battles. Most seniors think their estate planning is done when it's actually dangerously out of date. The Henderson family learned this devastating lesson when patriarch Walter passed away at 78. Walter thought he was prepared. He had a will from 1987 when his kids were young. What he didn't realize was that his will named his ex-wife, who had remarried, as executor, listed his old house that he'd sold years ago, and didn't account for his substantial 401k that had grown to over $800,000. Because Walter's beneficiary forms on his retirement accounts were never updated, the money went to his ex-wife instead of his current wife and children. His kids spent 3 years and $150,000 in legal fees fighting over an estate that should have been straightforward. The family relationships were permanently damaged, and Walter's current wife lost the financial security he thought he was providing for her. Here's what many seniors don't understand. Your beneficiary designations on retirement accounts, life insurance, and bank accounts override whatever your will says. If you named your ex-spouse as beneficiary in 1985 and never changed it, they're getting that money regardless of your will or current family situation. You need these 5 essential documents updated regularly. First, a current will that reflects your actual assets and wishes. Second, a financial power of attorney that allows someone to manage your money if you become incapacitated. Third, a healthcare power of attorney and advance directive for medical decisions. Fourth, updated beneficiary forms on all accounts. Fifth, if you have significant assets, a trust structure to avoid probate and minimize taxes. The timeline for estate planning reviews should be every 3 to 5 years, or immediately after major life events like marriage, divorce, birth of grandchildren, or significant changes in your financial situation. Many seniors make the mistake of thinking estate planning is a one-time event when it's actually an ongoing process. Here are common misconceptions that cost families dearly. Thinking that if you're married, everything automatically goes to your spouse. Not true in all states. Believing that you don't need estate planning if your assets are under the federal estate tax exemption. Probate and state taxes can still devastate your family. Assuming your adult children will work everything out fairly without legal guidance. Family dynamics change dramatically when money is involved. Take immediate action. First, locate all your estate planning documents and check the dates. Anything over 5 years old needs review. Second, make a list of all accounts with beneficiary designations and verify they're current. Third, have an honest conversation with your family about your wishes and the location of important documents. Walter's story haunts me because it was completely preventable. His grandson told me the family used to have big holiday gatherings, but now siblings barely speak to each other. The money Walter worked his entire life to save became a source of division instead of the blessing he intended. Don't let poor estate planning destroy your family's relationships and financial security. The few $1,000s you spend on proper legal advice could save your family hundreds of thousands and preserve the relationships you value most. What's your biggest estate planning concern? Are you worried about your documents being outdated, or are you unsure about having difficult conversations with your family? Share your thoughts below. The 6th and most heartbreaking trap is the increased vulnerability to scams and fraud that comes with aging. Seniors lose over $3 billion annually to financial scams, and the tactics are becoming more sophisticated every year. Even the smartest, most educated seniors can fall victim to these psychological manipulation techniques. Vernon, a 76-year-old widower and retired engineer from Florida, was lonely after his wife of 52 years passed away. He joined a seniors dating website where he met Susan, a woman who claimed to be a 68-year-old widow from the next town over. Susan was charming, asked about his late wife, and seemed to understand his grief perfectly. After 3 months of daily phone calls and emails, Susan had a crisis. Her daughter was in a car accident and needed emergency surgery, but she was traveling overseas and couldn't access her bank accounts. Could Vernon wire $15,000 to help with medical bills? She promised to pay him back immediately when she returned. Vernon, who had always been financially cautious, found himself at Western Union sending money to someone he'd never met in person. Over the next 6 months, Susan had a series of emergencies, legal problems, travel issues, medical expenses, each requiring Vernon to send more money. By the time Vernon realized he was being scammed, he had sent over $180,000, wiping out most of his life savings. The most insidious part of romance scams is that they exploit our natural desire for companionship and our instinct to help people we care about. The scammers study their victims for months, learning their vulnerabilities, family situations, and financial circumstances before making their move. Here are 7 red flags to watch for in any financial interaction. First, anyone who contacts you first about money, investments, or urgent opportunities. Second, requests for wire transfers, gift cards, or cryptocurrency payments. Third, pressure to make immediate decisions without time to think or consult family. Fourth, people who ask you to keep financial transactions secret from family or friends. Fifth, investment opportunities promising guaranteed high returns with no risk. Sixth, callers claiming to be from Medicare, Social Security, or the IRS demanding immediate payment. Seventh, anyone who asks for your personal information, like Social Security numbers or banking details, over the phone. Before any significant financial transaction, follow these 3 verification steps. First, independently verify the person's identity through official channels, not contact information they provide. Second, discuss the situation with a trusted family member or friend before sending any money. Third, sleep on it. Legitimate opportunities will still be there tomorrow, but scams create artificial urgency. Here's why seniors are particularly vulnerable. Normal aging can affect the parts of the brain responsible for detecting deception and evaluating risk. Social isolation makes seniors crave connection, which scammers exploit. Fixed incomes create anxiety about money, making opportunities seem more attractive. And generational differences in technology make it harder to spot sophisticated online scams. Create a buddy system for financial decisions. Choose a trusted adult, child, friend, or financial advisor who you'll consult before making any financial decision over $500. This isn't about losing your independence. It's about having a second set of eyes to spot red flags you might miss. Vernon's story has a tragic ending. The shame of being scammed led him to become even more isolated. He now questions every phone call and email, living in fear that he'll be targeted again. The scammers didn't just steal his money, they stole his trust in people and his confidence in his own judgment. Protect yourself by staying connected with family and friends, keeping your financial information private, and remembering that legitimate businesses and government agencies will never demand immediate payment or threaten you over the phone. Have you or someone you know been targeted by scammers? What red flags have you noticed? Share your experiences in the comments to help protect other seniors. Imagine the peace of mind you'll have knowing you've avoided these 6 financial traps. Instead of lying awake at night worrying about money running out, unexpected medical bills, or leaving your family with a mess to clean up, you'll sleep soundly knowing you've taken control of your financial future. Picture this. Your Social Security optimization strategy is adding an extra $2,000 to your monthly income for life. Your Medicare supplement coverage means that surprise medical bill won't devastate your savings. Your home equity decisions are based on logic, not emotion, giving you true financial flexibility. Your investment withdrawals are tax-efficient and sustainable, stretching your money for decades. Your estate planning is current and complete, ensuring your family will remember your legacy with love, not legal battles. And your awareness of scam tactics means you'll never fall victim to financial predators. The Henderson family I mentioned earlier? Walter's brother learned from their tragedy and updated his entire estate plan. His family now has clear instructions, updated beneficiaries, and peace of mind. Vernon's neighbor heard his story and implemented the buddy system. She's already avoided 2 scam attempts by consulting her daughter before responding. These aren't just financial strategies, they're dignity preservation tools. They ensure that your independence, your family relationships, and your peace of mind remain intact throughout your golden years. The seniors who master these concepts don't just have more money. They have more confidence, less stress, and stronger family bonds. But here's the bonus tip that ties everything together. The most dangerous financial mistake after 70 is isolation, making decisions alone without trusted advisors or family input. Don't let another day pass living with financial uncertainty. Every day you delay addressing these traps is money lost and peace of mind sacrificed. Hit that like button if this video opened your eyes to financial dangers you didn't know existed, and subscribe with notifications on. Share your biggest financial worry in the comments. Your question might become my next video topic, and please share this video with any senior who needs this information. Knowledge shared is protection multiplied.